You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back, Brandon. How are you doing this week?
Hello. Yeah, I'm doing well. Pretty good. I've gotten over my sore arm from my second COVID jab. Have you gotten over your back pain? How's your back feeling?
Yeah,
you feeling a little bit better?
I'm feeling better. It's actually kind of funny because Alex left a comment on the last week's video version of the podcast over on YouTube and nicely timestamped all of the sections of that podcast. So thank you, Alex, for doing that.
Thank you, Alex.
The first timestamp that he had there was me discussing how my back pain was caused by 5G. That's actually true. The testing is back, and it seems to be the case that is what happened after the vaccine. No,
you're gonna get our YouTube channel deleted. Remember when I was saying a couple of weeks ago that YouTube came through and swept through the anti-vaxxers? You can't say stuff like that, Hamish. You'll get deleted.
This show is comedy. It's a joke. It's a joke. YouTube. What's her name?
Just kidding.
Yeah, just a joke. It's just a joke. Please don't
Sarcasm.
delete don't delete our channel. No, but thanks, Alex, for doing that. That's actually very helpful.
It is helpful. Now we don't have to do it.
Yeah, we don't have to do it for that week at least.
I can appreciate that.
No, but we're well into the thick of earnings at the moment. We've got a couple of big ones this week to talk about. Google and Facebook. That's always fun to kind of go back and forth between the two advertising giants. We've got an update around, or a story around Tesla and a Hertz deal. An update around Evergrande, and we'll see if we can get to a couple other smaller stories as well. But we'll see how we go because this week is jam-packed. So
we got a lot.
Well, I think we'll just kind of get straight into it. So
let's
today's
roll.
episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. Allow you to track all of the different types of gains, capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, as well as use the tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So you can use that link to sign up to a free plan and use it for as long as you want. You can track up to 10 holdings. So for most people, that'll be suitable. You can try it out for as long as you want. But you can also sign up using that link to a paid plan, get access to more features. And if you use our link, you'll get 4 months off a yearly subscription. So it's a really good deal. Either way, whether you want a free account or a premium account, go check it out. And thanks to everyone who uses that link when you sign up. Even if you're signing up to a free plan, use that link. And it does help us out in a small way.
Absolutely.
So thank you very much.
Yeah, thanks, guys. All right, I want to start us off. Can I start us off with this Tesla Hertz story? Because this is actually bonkers. It's kind of like, yeah. I'll just tell you about it. We've been talking a lot about Tesla recently, actually. We had a hiatus. Yeah. We didn't speak about it for a long time, and now it's just like popping. It's making news every week. But this is a very interesting story. So this is on Monday. So on Monday, Hertz, the rental car company, announced they were going to buy 100,000 Model 3s to be available to their customers by 2023. So, they made it a big ad. They did this big thing, they got Tom Brady in the ad. They did the whole 9 yards. So they really wanted to show their customers, yep, we are going towards electric vehicles, get around us. It's actually going to be the largest EV rental fleet in the United States, which is kind of cool. And I did the calculations. It's going to cost a minimum of $4.5 billion.
Wow.
And that's just if they get the standard range plus cars. So that's the cheapest version of the Model 3 will be $4.5 billion total to get 100,000 of. And you might argue, oh, surely they're going to get some, big order discount. Well, actually, that's not the case, because Elon has always said with Tesla, the price is the price. He's never given anybody a discount for a celebrity. He's never given a free Tesla to somebody. He hasn't even given free cars to his family members. Literally everyone, including himself, that has a Tesla has purchased it, which is pretty crazy. There have been some things where charities have given away Teslas, but even the charities or the people that are sponsoring the charities have paid for the Tesla. So
that's an interesting approach to kind of keep it uniform across the board. No special deals for businesses or special people or anything like that. That's interesting. Interesting approach.
Every celebrity, every top dog, they've all bought their cars.
Wow.
Yeah, the price is the price for a Tesla. And you'll never find a discount on their website. There's no discounts at all. So it's a minimum of a $4.5 billion deal. But did you see what it did to the stock, Hamish?
I saw something. It went up a lot. I don't know by how much it went up by.
So it pushed the share price up 12.66% on that day.
Of course it did.
Yeah. So it lifted the share price to $1,024. And the reason that it made a big hoo-ha is because it lifted the market cap past $1 trillion. How crazy is that?
Wow.
$1 trillion market cap for a company that doesn't actually make that much money.
That's insane. Yeah, that's crazy. They must be pretty much back at almost 1,000 PE now again, right? Because I know they were over 1,000 price to earnings ratio for a while. Then it kind of went down quite quickly because their earnings have been rising quite quickly.
It says it's 300 only 336.
Really?
I don't know.
Yeah,
that's just what I'm getting off of the Tesla, the Google finance page thing.
Right. Maybe after their latest earnings, that kind of pushed it down even further a little bit, but
maybe.
Yeah. Okay. Well, that's crazy. $1 trillion company. When did Apple cross the mark? Was it in
it's only a couple of years ago.
2019 or something like that?
Yeah, probably around then.
And they were doing a lot more than a couple billion in profit at the time. So crazy
This is the crazy thing. And beyond the idea that Tesla's got a $1 trillion market cap, if you haven't kind of done the maths in your head already, if you haven't drawn to this conclusion, this the share price is now $1,024, or was. The market cap's now just gone past $1 trillion. That's up 12.66% in one day. So the 12.6% share price rise lifted the market cap $115 billion. 115 billion. Remember, the deal was only worth $4.5 billion. How insane is that? Hertz has said, we're going to buy $4.5 billion worth of Teslas. And because of that news, the market cap went up $115 billion.
Yeah. And I mean, to be fair, if it had gone up just 4.5 billion, I think that you could have made the argument that there's more value created than just the $4.5 billion deal on paper right now. It's more awareness for Tesla. There'll be more people trying out Teslas and then maybe wanting to go and buy them themselves. But even with all of that considered, that's a big increase.
And you bring up a good point. That is exactly what the Tesla bulls were saying, is that, it's 100,000 cars, but it's 100,000 into a rental fleet. That means there's going to be 100,000 people regularly rotating through Teslas, probably for the first time. Might lead to further sales, more butts in seats, more sales, people want to buy a Tesla, blah, 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 and so on. But it's pretty crazy. That's $4.5 billion in revenue. So remember, it's not like $4.5 billion in profit. I mean, car companies, they're running on like a 15% operating margin, I think. So Yeah, but still pretty insane. Pretty insane. But,
yeah, actually, when you put it that way, that would mean that they would have to produce, if the market cap goes up 115 billion and you think of that as extra profit that the business needs to deliver to Tesla at a minimum, then you're really talking about this deal needing to generate $500+ billion of revenue for Tesla for that rise to make sense.
Yeah,
so
it's pretty nuts.
It gets even more insane when you think of it that way. But yeah, it's interesting deal. I do think it's probably a very good deal for Tesla. I do agree that there's probably a lot of people who maybe know nobody who owns a Tesla and they've just never experienced it. And maybe this will give them the opportunity to do that. And that might push them over the fence to decide. Whatever wasn't Hertz on the brink of bankruptcy? How are they doing? How are they doing a $5 billion deal?
I don't know. To be honest, I wasn't even following Hertz, but yeah, they were right on the brink of bankruptcy.
That was in 2020 as well. This was like a year ago.
Yeah, it was recently. Yeah, there was something like people were.
Oh, they did file for bankruptcy. Wow. They filed.
Yeah, they tried to do a last ditch capital raise attempt or something like that.
Yeah,
I can't quite remember the specifics, but clearly they're still around. I don't know. Did they go bust and just be able to restructure, reorganize, get in new shareholders?
Yeah, I'm trying to look. So the company was on the brink of bankruptcy. Then the stock, remember, was going through. It became it was like a meme stock before
It
basically became a meme stock. So the stock price shot up. They raised $500 million in stock, and then the deal was cancelled by the SEC.
Oh.
So they said, no, you can't do that, which makes sense because that's horrible. That's a terrible thing to do. But yeah, it says here that they actually filed for Chapter 11 bankruptcy. So
okay,
I guess they restructured, got new investors. The old investors got nothing, I guess, and then new ones came in, and less than a year later.
And here we are.
$5 billion, doing the biggest. What did you say? There's some stat about this being
largest EV rental fleet in the US.
Yeah, there you go.
Yeah, so there you go. Anyway, quick story. That's Tesla. A little bit more kind of bonkers stock market speculation kind of news that just doesn't seem like it should be real, but it is. Should we go to some earnings next?
Yeah, let's tackle these two online advertising giants. As I said, it's always fun to kind of go back and forth between these two because they report usually a day or two apart from each other. So you get one and that gives you a bit of an insight into, what to expect for the other one. And then the other one comes out and you can kind of compare and contrast the two. And of course, the two businesses are not identical, right? They're doing different things right now and will be doing very different things in the future, particularly with where Facebook is trying to drive their business. But we'll start off with Facebook. Facebook was the first to report out of the two. Revenue came in at $29 billion for the quarter, up 35% year over year. So continuing to see massive growth.
That's big.
Quarter after quarter. And of course, in Facebook, revenue is driven by really two key things. One is user growth, so how many users are on the platform, and then revenue per user. So how much advertiser dollars are they able to squeeze out of people engaging in the platform and seeing ads as they use the platform. But in terms of user growth, so user growth continued to grow. In terms of the Facebook.com platform, daily active users hit 1.93 billion, which was up 6% year over year. Monthly active users for the Facebook.com platform was 2.91 billion, up 6% year over year. So again, both of those up 6%. Growth is continuing to slow on their main platform, but still going up, surprisingly. I'm actually surprised that it's still going up at all. But yeah, it's kind of trickled down slowly over time, up 9%, up 8%, up 6%. That'll probably continue, I would imagine. And then in terms of their overall family of apps, so including Instagram, Messenger, WhatsApp, on a daily basis, they have 2.81 billion users, up 11% year over year. And on a monthly basis, they have 3.58 billion users, up 12% year over year. So their other apps are obviously, as you can see from the difference between their Facebook.com app and their other apps, Instagram, WhatsApp, those ones are driving much more of the growth.
More growth,
overall. Interesting stat, 60% of people with access to the internet use Facebook every single day, which is...
wow.
That's
jeez.
Talk about market dominance. That's
I reckon.
That's yeah. They have a considerable grasp on a lot of people. I would imagine a significant amount of that is Instagram and Messenger. I guess WhatsApp as well. A lot of people use as well. So
true. I definitely use Messenger every day.
Yeah.
Yeah. What do you normally use? Do you use WhatsApp or no?
I don't use. Actually, no, I do. I don't know why we do this, but I have our family kind of group chat is just in WhatsApp. The reason we do that is because my parents don't have Facebook, so we use WhatsApp for that. But that's the only thing I use. But I actually do use WhatsApp. I just realized from that every day, and then Messenger every day. Use Instagram every day. I use Facebook every day for my business.
Right.
So I'm contributing to all four buckets.
Wow, there you go. Do you run any Facebook ads?
I don't run any Facebook ads, but I have my.
That was going to be the perfect.
No.
Yeah, get a badge in every category there.
Yeah, I don't contribute to the revenue. I'm just for the user side. No, but just in Facebook, just for our private community is on Facebook. So I'm in there every day. But yeah, it's a lot of people use it, but growth is slowing on that side. So of course, growth has to come from, or can come, I should say, from somewhere else, which is revenue produced per user. So essentially, this is expected to continue to be a significant driver for revenue growth for the business, because
that makes sense.
There is a significant amount more companies that need to move their advertising dollars from traditional means online. And that simply means that even as the number of users, the growth in users slows down, the amount advertisers are willing to pay to get in front of those users is always rising. So in terms of what that specifically looks like, on a worldwide basis, revenue per user for Facebook is currently $10 per user. And that was up 27% year over year. So big increase in that. And then in terms of some of the more specific segments, so you have the US and Canada segment, which generates $52.34 per user, which was up 32% year over year.
Wow.
So that kind of gives you an interesting insight into the potential if other parts of the world continue to see an increase in revenue. The US and Canada segment is $52, whereas the average business, or the average user on Facebook is just $10, a fifth. So there's a significant disparity there. And then the smallest but fastest growing category is, of course, rest of world. That segment generates just $3.14 per user and was up 41%. Year over year.
So that's just everywhere that's not US and Canada?
No. So they have US and Canada, they have a Europe segment, and they have an Asia Pacific, and then they have a rest of world. So I think Europe was the slowest growth. I want to say they had about 30% growth.
Right.
Asia Pacific, I can't remember off the top of my head. And then rest of world was the fastest, but the smallest dollar figure.
Right.
But yeah, I mean, even in the category of US and Canada, where they're already generating $50 per user, it's growing at 30% per year, because there is such a demand for advertising to people in the US and Canada.
To Americans,
so, yeah.
Wow. That's crazy. But yeah, it does show you that there's a lot of potential outside of the US and Canada. I imagine that's always going to be their main market, though, by a long shot. But yeah, that does blow my mind. US and Canada, $52.34 per user. Worldwide, it's only $10. That's crazy. Man, it kind of makes me want to start running ads here in Australia. I feel like I'm getting a good deal.
I wonder what it is. I wonder what it looks like, because we obviously can't see Australia's segment broken out, but I imagine we sit in that Asia Pacific segment.
We would.
But I can't remember off the top of my head what the specific numbers were for that. But
interesting.
Yeah, there you go. In terms of income from operations, that came in at $10.4 billion, which was up 30% year over year. So a little bit slower growth on the profit side than revenue, as costs continue to be a larger percentage, or take a larger percentage from revenue. In terms of what else is happening at the business, they're actually going to be changing how they segment their revenue starting next year. So at the moment, they segment it into advertising, which includes all the revenue generated from advertising on all of their platforms. And then they have an other segment, which includes a very small amount of payments, but mostly the VR and AR products that they sell. Their Oculus products. Starting next year, they're going to break it out into one that is called Family of Apps, I believe, and that will be all of the revenue generated from their social apps. So not just advertising, but also add on the tiny amount of payments that they generate from WhatsApp and that sort of thing.
Right.
And then the other segment will be Reality Labs, which is going to be strictly their virtual reality and augmented reality physical products, as well as the Metaverse business unit, this online space, this VR, AR online space that they're just embarking on creating. So
the Matrix.
While it probably won't, I would imagine, itself produce any revenue for a very long time, they'll be able to segment out the costs for that business and show where money's going and what they're doing specifically with that business unit. And in terms of that, next year they said they're planning on spending $10 billion to start work on that metaverse. So they basically said profits next year will be $10 billion less than, what it would have been if we weren't doing this. And, that's a significant hit to their short-term profitability. But of course, this is the goal of driving long-term growth for the business and laying out a long-term plan that allows for growth beyond when the online advertising industry is saturated, because even though there's a lot of room for it to continue to grow at the moment, that's not always going to be the case. That's going to dry up at some point. Facebook and Google have such a dominant position in the industry that they're at the moment just capturing pretty much everything that comes online. And when that tap kind of slows down as online advertising becomes the dominant way that people advertise, and they've already captured a lot of that revenue, they'll need to look elsewhere to generate revenue. Yeah. And maybe some of that is payments on their platforms with some more e-commerce solutions in Instagram and WhatsApp. But a lot of it is hopefully going to come from this new business that they're developing. So
it is hard to conceptualize. It's hard to visualize what this thing's going to look like, though, isn't it?
Yeah.
It's so abstract, the kind of idea behind it.
Yeah.
I just struggle. Struggle to picture.
I think, and it's also going to be difficult to kind of conceptualize because they want to create a space that can be accessed with a variety of different devices. So it would be like at the moment you can access Facebook, let's say on your computer or on your phone, and it's a very like two-dimensional experience, right? You're just kind of scrolling along. It would be as if you could do that, but then there was also another option where you can stick on a VR headset and you're still in Facebook, but it's a physical experience.
Yeah.
So there will still be, so there will still be what it actually is or what the experience is will still depend on how you're accessing it.
Right.
But they want to create more of an online space that pushes people more into using VR. And I think there's a lot of cool things that they can do, particularly around businesses. I mean, I think Zoom calls for meetings is, it's like a stepping stone for what eventually meetings will be, which is, I think, people having some kind of VR headset, putting it on and being in a virtual space with other people in a virtual office where you can actually stand up and point at a whiteboard, or, you're drawing in the air in your home office, but you're actually drawing on a whiteboard that everyone else can see, and it's much more engaging. You can make eye contact with people rather than just being on a flat screen. So I can see a lot of application for the metaverse in a lot of different ways in terms of gaming, social media, and business. But what it will end up looking like and how it takes shape will be kind of something we'll see over time.
You can really see that this could start actually becoming like the Matrix.
Yeah.
Like how you put, I guess what's it? I haven't seen it in a long time, but you're like unconscious in like this big machine, but the virtual world you're in feels like reality. It could start to get, you put your glasses on, and I think of what they do with like the Unreal engines. Have you seen some of the stuff they can do with Unreal Engine, like the graphics and that sort of stuff that they're pulling off these days? I mean, imagine if you could put, obviously this is down the track, we need much stronger like, CPUs and GPUs to be able to handle these sort of kind of data sets and whatever. But imagine just putting on those glasses and kind of being in this realistic looking virtual space. I mean, you could use your controls in your hands and walk down the street, and you might go into the virtual Rebel Sport or something. You might go into the virtual EB Games or GameStop, and you pick up Amazon, and you go in and you're like, oh, Amazon, I'm here now. I want to go look at the electronics, and you could pick up the new iPhone in the virtual space and twirl it around and go, oh yeah, actually that looks pretty cool. I like the size. Yeah, it looks nice. You could purchase that and then it'll just be sent to you. Yeah. Amazon will just ship. There's so many possibilities here. It's crazy.
Yeah, well, I think about, if you kind of think about the way that you experience the internet at the moment, let me just give you an example of how, like, what I might be doing, let's say, after I finish work on a certain day. Maybe I have one tab open that has a YouTube video open, and I'm watching a YouTube video. And then another tab, or maybe on my phone, I'm messaging with someone or messaging in a group chat or something like that. And then maybe on another tab, I'm shopping for something, right? That's how you kind of experience the internet now. The metaverse is supposed to be a place that you can go where you can do all of those things, but it's not this disconnected experience. Like, you're walking around a physical place, and you can talk to the people you're talking to while you're physically, well, not physically, but you're virtually shopping for the thing that you were shopping for. Or maybe you're sitting next to your friends talking about what you wanted to talk about on Facebook, and you're watching the YouTube video in a virtual theater, right? And they could be watching whatever they want to watch, and you're watching whatever you want to watch, but you can talk while watching the video at the same time. More of a inclusive experience, I guess, online.
Man.
So I think there's a lot of cool things they could do. Obviously, I'm not at Facebook, so I don't know what they're planning on doing first, but tomorrow they're actually doing a Facebook Connect event, which is their kind of Reality Labs event where they talk about virtual reality. That'll be out now for people who are listening to this. So you can go check that out on the Oculus YouTube channel. But I'm really excited to watch that and see what they're planning on doing, because they're going to spend $10 billion next year. So they
got the cash.
They better have something exciting in the works.
I mean, honestly, like, some people probably hear this and go, I'm never going to, that sounds like a waste of money. I'm never going to jump on that. But I mean, in all honesty, I kind of support them, because they're just, at least they're a company that's trying to do something different.
Yeah.
Like, I always criticize Apple because they just do the same thing every single year. They got so much money, and they're like, you know what? Nah, let's just a minor update to all our products, and out they go. A new iPhone 12, 13, 14, 15 with minor bumps in the specs. But they don't really care about doing something new or different. I mean, they're pretty much done. They're giving away all their money back to their shareholders. It's just, I like it when these super successful companies, which got successful because they did something different, continue to do things differently. That's what I like to see.
Yeah.
But,
they're definitely taking
some companies do, some companies don't.
Yeah. Yeah, exactly right. Well, I think that's pretty much, the only other thing I wanted to say for Facebook was they mentioned briefly about the iOS headwinds that they continue to face. So, of course, Apple changed its privacy, had some privacy changes on their iPhones where they basically prompted users if they wanted to opt out of app tracking, so that they could not receive targeted ads on other apps. So when you're in a game, for example, you can not see targeted ads from Facebook. And that's, not the most significant, but one way that Facebook generates a lot of their advertising revenue. And Facebook just said that they've continued to see impacts of that. Their revenue was actually flat from Q3 to Q2 this year. And they quoted that the biggest impact for the reason why they didn't beat Q2 was because of those iOS changes. Essentially meaning that certain ads are less targeted and then performing worse for businesses. So businesses are opting to run less of those ads.
Interesting.
So, interesting kind of, problem that's going on. Snapchat they quoted the same problems for why their revenue actually declined during the quarter. Okay. And then I think Twitter said that they didn't feel the impact. So there's kind of a bunch of different advertising businesses feeling it in different ways, I think, depending on how much people use the app on iPhones specifically. So yeah, that was the last thing I just wanted to mention for Facebook. And I don't think anything really happened with the stock. I'm pretty sure it was kind of down a couple of percent or something like that, up a couple of percent. Nothing too crazy.
Nothing crazy. Yeah. Well, with that said, let's move on to Google then. Should we move on?
Yes, let's do it.
All right. Well, Google. Hello. Revenue of $65 billion in the quarter, up 41% year over year. That's pretty mind-blowing.
That's crazy.
41% increase. What was Facebook's increase? 35%. Yeah. So, my company's better than yours. So operating income of $21 billion. So operating margin of 32%. They had strong growth in pretty much every business segment. So we'll just go through them. So there's Google search. That was up 43% year over year. They say driven by increases in search queries resulting from growth in user adoption and usage, primarily on mobile devices, growth in advertiser spending, and improvements we've made in ad formats and delivery. So Google search is obviously the core of Google's business, Alphabet's business, up 33% year over year. That is a big change. Then next they list YouTube ads, also up 43% year over year. So very strong performance in the YouTube space. What else have we got? Google Network. So that's up 39% year over year. This is essentially third parties using Google Ads. So essentially people using AdMob, AdSense, or Google Ad Manager. So 39% increase in Google Network. And then it's those three that make up whatever it is, Google advertising, their kind of broader category. No, go away, Google. No, I don't want you to. That's my phone. Sorry.
I need to do that as well.
Yeah, quick. We better switch off our phone. Do you have a Google phone?
I have a Samsung, so it has.
Samsung. So it has. Right. Okay. Yep. Turn you off. Please don't say that. Okay. Back on track. Then we also had. So obviously big increases in the ad business. I just wanted to note here that in their 10Q, they note that year over year, there was a 22% increase in paid clicks and then an 18% rise in cost per click. So talking about what you were talking about before with Facebook, how it's like how many ads are shown, that's like how many users are there, and then also how much are advertisers paying for each one of those ads or each one of those clicks. So 22% increase in paid clicks total, and then 18% rise in the cost per click.
Yeah.
So there you go.
Yeah. And I mean, Google's still seeing a massive increase in the number of clicks. And that obviously puts a little bit of downward pressure on the cost per click, because you can think of it like real estate. If there's more real estate available, the cost per building there's going to be downward pressure on the cost per building. But as soon as there's a limited amount of real estate, but there's more demand for advertising, which is this big push, then the cost per click would be rising faster. So Facebook's kind of going through that a little bit earlier than Google, I think, where the number of users is slowing to single digits, or has been single digit growth for quite a while now. But they're now seeing, 30, 40% growth in the revenue per user. Google's kind of in the middle ground still, where they're getting a lot more clicks on their platform. I'm sure a lot of that's driven through YouTube and search as well. And then as a result, even though there is an increase in the number of clicks and the number of ads servings that can be done, they're still seeing an increase in the cost per click, because there's just so much demand for online advertising.
Yeah, but not as much as like the Facebook case. Yeah, exactly right. Okay, so that's ads. If we move beyond ads, there was also Google Other. That was up by 23% year over year. This is Android, Google Play Store, the Google phones like the Pixel, so hardware sales, Google Maps, Chrome, those kind of extra things that Google owns. So that was also up 23% year over year, so very good growth there. Cloud revenue up by 45% year over year, so that's coming along very nicely, although still not running profitably, which we'll talk about in a second. And even Other Bets was up 2% year over year. This is just kind of like the collection of experiments that Google runs. Hopefully one day they will become big businesses, but they're kind of just toying around with them. With all that, but that was revenue, right? So it all, growing very nicely between 20 and 50% year over year in the revenue department. But you can then look at, what's most important to Google? So we actually have a look at the operating income of each of these different businesses, and the Google the Google business, which is predominantly, the Google business, so Google advertising and all that, which is predominantly ads, is currently 23.9 billion of their operating income, or 113% of their operating income.
Oh, right.
So yes, which just means that cloud's currently losing 644 million per quarter, and Other Bets loses 1.3 billion per quarter. So yeah, that's crazy. In the case of Google, it's ads.
Surprise, surprise.
Yeah, exactly. But I do think that's interesting. You shouldn't just look at revenue, because obviously it can be a little bit misleading when you actually look at operating income. Cloud is nothing. Other Bets loses money, and it's really just all Google ads, essentially. Then in terms of, I've triggered my phone again. In terms of balance sheet, I just wanted to go through this because I always like to look at Google's balance sheet. They have $142 billion in cash and cash equivalents.
Oh my God.
They have $184 billion in current assets, $62 billion in current liabilities. How's that for a current ratio? That's pretty nice, isn't it?
That's crazy.
Yeah. They have $347 billion in total assets and $103 billion in total liabilities, of which $14 billion is long-term debt. So, $142 billion in the bank and $14 billion in debt. It's not too bad, is it?
Yeah, it's a pretty good ratio.
Nice ratio.
There.
Yeah. But yeah, that's pretty much what I had for Google. Just pretty dominant increases in all parts of their business, really.
Yeah.
Yeah.
Fantastic. I just realized I didn't talk about balance sheets. Maybe we can do a little contrast. So you've got 142 billion in cash and cash equivalents. Does that include their short-term investments, or is that just cash and cash equivalents?
So it includes their what they hold in treasuries and stuff like that.
Yeah, okay. So I think Facebook has
marketable securities. Yeah, short-term marketable securities.
Facebook's at 58 billion, so at about quite a lot less. What have they got? Total assets of 170 billion, total liabilities of 36 billion, and then so that gives them total equity of 133.4 billion. So there you go. Yeah, Facebook's a fairly smaller business than Google at this point.
But it's still a tank.
It is a tank. Yeah, I think these two businesses probably do have the best balance sheet out of any business.
Yeah, Facebook's still got no debt at all, right?
Yeah, exactly.
Pretty sure they got zero.
Yeah, they have 36 billion in total liabilities. It's a tiny amount. It's
that's crazy.
Yeah, very interesting. All right.
Yeah, honestly, I agree. These two businesses, probably Google's a little bit stronger, but these two businesses have the best balance sheets you'll probably ever see. Actually, that's not true. We'll probably see better balance sheets in the future. But they'll probably still be Google and Facebook balance sheets that will be very strong in 10, 20 years.
Yeah.
Anyway, should we move on?
Yeah. Where should we go from here? Actually, I had a bit of an update on Evergrande. So we've been talking about Evergrande, I guess. We spoke about them last week. So last week we were talking about the deal they tried to strike with a smaller property developer. Can't remember the name of it off the top of my head. It started with H, I think. And they tried to sell, or they were trying to work out a deal to sell about $2 to $3 billion worth of their property services business. So a drop in the bucket of the $300 billion in liabilities that they have to cover, but it would have allowed them to have some cash to make a number of payments that were coming due very, very quickly. So they had those two bond payments that had expired but had a 30-day grace period. And at the end of the 30-day grace period, if they still hadn't paid those two bonds, or either of them really, they would have officially gone solvent.
Curtains.
So they would have had to stop operating, and that would have been it. And the first one last week when we were speaking was almost 30 days due, I think. And then on the 28th day, they made the payment. So they made that first payment, which was $83.5 million. So they successfully made that one. However, they have another one that's due extremely quickly after that one. The next one is due on the 29th of October. So that's tomorrow for us, but I guess that will have passed by the time you're listening to this. That one is 47.5 million. So I guess after this weekend, we'll kind of see whether they made that one. Yeah. But they weren't expected to make the first one, and they did. So we'll see what happens. The news today, just the very small amount of news that I wanted to talk about was that China is actually urging the founder of Evergrande to use his own personal wealth to settle the bonds. So clearly, I think that the Chinese government is very reluctant to step in and do something to prevent it from failing. So they're kind of calling on the founder to say, "Hey, just you're a billionaire. Use some of your other wealth to help out the company that you founded." So billionaire, I'm going to butcher this name, Hu Kai-yan? I don't know.
Sounds about right.
So they were, Chinese authorities told the billionaire to use his personal wealth to alleviate China's Evergrande's deepening debt crisis, according to people familiar with the matter. So there you go.
There it is again.
We got another one of those.
Allegedly. That's great. Yeah, I reckon he started it. He's a billionaire. Come on. What's this? A tiny amount. 47.5 million. Come on. Yeah, man.
It's not much. Yeah. His net worth at the moment, I think, is estimated to be about $8 billion US. So,
right.
He could easily make that first payment, but I don't think that helps to overcome the 300 billion in liabilities that they've accrued. So, I mean, he could prevent it from crashing this week. Maybe, if he sold some. And the other thing is, I think it's unknown. Well, according to the article, it is unknown how much of his net worth is liquid enough to actually make the payments. And you kind of spoke about this idea with Elon Musk and his massive wealth and how it's not liquid at all. Like he has, hundreds of billions of dollars in net worth, but it's not just in his bank account. He can't just he can't just Venmo you $1 billion. It's all tied up in Tesla stock that has that's kind of been used for loans that he's used for SpaceX and that sort of thing. So we'll see whether he steps in, but I think it's unlikely. I mean, honestly, if I'm in his position, you would just be kicking the can down the road. It would just be would really. I mean, obviously the bond holders would love to get paid, so that would be the positive thing that would come out of it, versus them just defaulting and them not getting paid. But there's a lot of people who are not going to be paid, I think. At this stage,
I think you're right. But that's really interesting that it could be like just a few days from now before we have we could potentially have an answer.
Yeah.
But yeah, man, it's just, you're exactly right with that last point. Just the $300 billion of liability. It's just a bloody big mountain to climb.
Yeah.
It's just
I mean, the next couple of bond payments, they really don't matter. It's just whether it's not really a matter of whether they will fail. It's more of when, or the Chinese government steps in and does some kind of buyout where they would likely take public control, government control of the business or segments of the business, and cover the liabilities for them.
Yeah.
One of those two things is inevitably going to happen. When? Who knows? Could have already happened by the time you're listening to this. Maybe the headline's already out that they're insolvent and can no longer operate. But we will see. I'm sure we'll have some updates on it next week. A brief update again, whether it'll be they're bankrupt or whether it'll be they made it, but they've got this one in, I don't know, another couple of weeks
next
or something.
Yeah, exactly. And they've got other bond payments that are due in a couple weeks time. There's even more, and it just keeps rolling. That's the problem, is it just doesn't stop.
No, it's not going to stop.
Yeah. So it's like, if you're struggling to make payments now, are you going to be in a better position in a year's time when, more and more and more have come due? That's why I say it just seems unlikely that they're just, like you say, kind of kicking the can down the road. But yeah, I guess that's Evergrande. We'll see what happens.
Yeah.
Do you want to run through what's happening with Robinhood? This seems interesting.
Yeah. So
what's going on with Robinhood?
Yeah, we spoke about, I think the last time we spoke about Robinhood stock was, of course, when it IPO'd back in late July, start of August. So it went public, of course, the trading app Robinhood, and it was extremely overhyped, I think, at the time.
It's fair to say.
Yeah, I mean, the stock was doing extremely well. I think it IPO'd at around $35 per share. It then reached $70 per share within a couple of days. And at $70 per share, it had a valuation of $60 billion. So, it was... just a little $60 billion valuation. It's only pushing up into MasterCard, just the second biggest payments company ever.
That's insane. I want to have a look. That's actually bonkers.
I think MasterCard's about about 100.
Oh wow! What the heck? It's 331 billion.
I was wrong.
Maybe not.
I stand corrected.
Yeah.
Was it Visa? Is Visa smaller? No, Visa's 500 billion. Wow. Okay. Well, there you go. I stand corrected.
Yeah. But yeah, it's nevertheless, it's insane.
Yeah.
It's an insane valuation.
Yeah. But maybe they produce a lot of profit, Brandon. Maybe.
Oh, that's true. That's a good point.
Maybe they
can't count them out.
They must produce billions of dollars worth of profit and tens of billions of dollars worth of revenue for that kind of valuation.
Oh, yeah, of course.
No, but so they released their third quarter 2021 results, and it was the headline was it was a disaster. So not my words.
You're just trying to dodge bullets here. That's hilarious.
Yeah, I'm just reading the headline.
It was allegedly a disaster.
Yeah, allegedly. According to people familiar with the matter, it's not worth $60 billion anymore.
Oh gosh, that's funny.
No, so third quarter total net revenue came in at $365 million with an M, not a B, and that missed an estimate of 431. I'm having way too much fun with this, and it missed an estimate of 431.5 million. So by quite a substantial mark. But I mean, expectations are expectations for quarterly earnings. They are what they are, and they don't really matter to the underlying business. I think what matters is the raw numbers that they're producing. But revenue actually increased 35% year over year, but was well below last quarter, which was 565 million. So they saw a significant decline. And the reason for that decline was last quarter had a massive surge from crypto trading. In particular, Dogecoin went through a huge amount of trading volume and generated a lot of transactional trading volume for Robinhood. Right. And in terms of that transaction-based revenue, it totaled $267 million in the quarter, and only $51 million of that came from cryptocurrency, whereas in the previous quarter, $233 million came from cryptocurrency alone. So the current transactional revenue for Q3 was almost the same as just crypto trading in the second quarter. So that kind of shows you how much these kind of short bursts of these meme cryptocurrencies and tweets that Elon does, and the crypto goes up a bunch, how much that actually generates in revenue, and how much of a difference it can make for a business like this. So that's kind of what's going on in terms of accounts. So they actually also continue to see a decline in the number of users. So net cumulative accounts dropped to 22.4 million compared to 22.5 million in the second quarter. So basically flat, I guess. Monthly active users totaled 18.9 million, which was down from 21.3 million. Average revenue per user decreased by 36% year over year. So last year in the third quarter, it was $102 per user. Now it's $65 per user. Wow. And Robinhood reported a net loss of $1.32 billion. So,
jeez, there's some big drops.
Yeah,
big drop offs.
Go on.
Just shows you that people on Robinhood, they're not really investing, are they? It's just like you look at how much, and it just creates a whole web of, Robinhood is essentially if they can convince people, and this is the problem with stockbrokers generally, but if they can convince people to trade more crypto, or they can convince people to get on the meme stock bandwagon and whatever, then they make more money. So it's just an environment where they're financially incentivized to encourage the wrong type of investing behavior.
Yeah.
And that's the fundamental reason why personally I don't even look into them in terms of making an investment in Robinhood. But it's just crazy.
Yeah.
And it's worrying that so much. Yeah, it's just like they had such a big boost in their business. It's just people trading Dogecoin. I mean, that just makes me a little bit nervous.
Yeah. It's a strange business for me to wrap my head around, because I don't think there's anything like I don't think there's anything inherently wrong with like sports betting apps, for example. Like I think that, as long as they've got the right controls in place to, so if someone is feeling as though they're getting addicted, that they can block their account and, restrict themselves from having access to it. I think a lot of people have fun, sports betting and having that as kind of a social, an added social thing that you do with your friends or whatever. So I don't think there's anything inherently wrong with that. And in the same light, I don't think there's anything inherently wrong with doing the same thing with crypto or with stocks.
Stock market,
I think it's just a different kind of domain. But it is kind of a weird, blurred area where some people describe Robinhood as democratizing investments and wealth creation. But the reality of what happens within the business is much closer to the sports betting side, I think. So it's kind of a weird combination of things where when you think of stocks, I mean, I don't think of gambling. I just think of wealth creation and ownership of businesses. But Robinhood's this space where you blur the lines between, wealth creation and gambling. And that's where I'm kind of confused a little bit by the business, because if people are conflating the two things, then that's not good. But I don't know. Yeah, that's kind of my thoughts on the business itself. I think it's obviously a necessary step in allowing more people to have access to their own portfolios. And, just because you can trade for free every second doesn't mean that everyone on the app is, and it just means that there's more people who can access real wealth creation if they're using it in the right way. So, I don't know, but disastrous quarter, I think is the right way to describe what happened. Drop in users, drop in revenue, a bigger loss, drop in revenue per user. So it wasn't the greatest quarter, just a quarter. So, you can think of it as that it's just a quarter, but, certainly when you put that in the business itself, as it currently is in perspective to a $60 billion valuation it had a couple of months ago, some things are not adding up,
Yeah.
1 + 1 doesn't
crazy.
equal 60 billion.
Nah, I agree. Nothing to add. Shall we move on into Q&A?
Yeah, let's do it. We've got time to get through a couple of questions here.
I'll ask. Can I ask this one to you, because it's related to your videos?
Yeah.
I'll say, hey guys, thanks. This one says, hey guys, thanks for the great content. I've watched Hamish's video on how to calculate intrinsic value and the buy price by assuming a 22% rate of return. I'm wondering, do you ever take dividends into account when doing the rate of return, therefore going for a lower rate, i.e. 22% minus the dividend yield? Yeah,
that's a really good question, because, and I'm imagining this question is coming from the perspective of maybe someone who's listened to a lot of Phil Town's valuation. It depends on what you're discounting, right? So in Phil Town's situation, where he's coming up with an estimate of what the future stock price will be, right? So his method is to project out earnings per share, then you add a price to earnings multiple on top, and as a result, you get a price that the business will be at in the future. And then, you can discount that back at 22%, so you can divide it by 8 essentially, and that will give you a price to pay today. So what you're discounting in that process is you're discounting the stock price, right? So obviously, the stock price is only one way that you make money as an investor. It's the stock price and dividends. So if you wanted to take into account dividends using Phil Town's method, you would want to adjust the discount rate by the yearly expected dividend from that business. Why you don't do that with the method that I do is because I'm not discounting a future stock price. I'm discounting cash flow. And that cash flow represents the stock price increase, so money that is reinvested in the business and increases the value of the business and therefore increases the price of the business, but also cash flow that could be distributed as a dividend. So I'm already accounting for dividends in the fact that I'm looking at free cash flow or cash flow for owners or owners' earnings, all relatively the same number, right? You're coming up with a figure of how much cash is left over after the business. And if they pay that all out as a dividend, that's how you receive it. Or they might keep it all in the business and it will be in the stock price. Or it might be half and half. Or some of it might be for share repurchases and that will also be in the stock price. So
you get it somehow.
Exactly. So I don't actually have to adjust for dividends. I'm simply calculating the total amount of cash the business produces, and I'm expecting that I will receive it one way or the other, either reinvested in the business and in the stock price, or through dividends, or a combination of both in most cases. So I hope that makes sense.
Yep. Nothing to add.
All right, let's move on. Where do you want me to go from here? Do you want me to just continue on?
Wherever. Yeah, sure. Let's go.
Hey guys, love the podcast. Just wondering why you both moved from an EPS value model commonly taught by Phil Town. Oh, this is kind of related to what we were just talking about.
It's kind of similar,
works. So why did you move from an EPS valuation model commonly taught by Phil Town to a discounted cash flow model commonly used by other investors such as Monish Prabrai? I understand the difference between free cash flow and earnings per share, and that the models have similar approaches in discounting to the stock's present value. However, I'd be interested to know why you both moved to a discounted cash flow model.
I mean, personally, I just like free cash flow or cash flow for owners if you want to factor in, if you want to factor out
growth capex
growth capex. Yeah. I just like it because the free cash flow is really just it's the amount, it just makes sense in my head. It's the amount of money that you as the business owner are getting. Like that's your money. So I like to use free cash flow and, model that out into the future and discount it back. And I think about, you think about the business like you're buying the whole thing. So I don't think about, I'm buying it at stock price, earnings per share. This is just like, how much am I paying for the whole business? I think about it. And this is what Warren Buffett says. Think about it as though you're just buying the whole business. Think about it as a business owner. How much is that business making for you as the owner? Model that out into the future and then follow your discounted cash flow process. That's really just the main reason that I like it. I think the EPS Phil Town version is easier to understand and probably easier to implement. And that's what I was doing when I was more of a beginner. But now that I've taken the time to understand the discounted cash flow model, it just feels like a better way to go about it, more thorough, more appropriate for what we're trying to do and what mindset we're in. If that makes sense. Does that make sense?
Yeah, so I mean, it's one thing to kind of think about the difference between EPS and free cash flow. I think it seems like you understand the difference. Earnings per share includes non-cash revenue and expenses, so free cash flow is a better representation of the cash left over. But you could still from that point take free cash flow and add a multiple, and that would be kind of similar to Phil Town's method, and still not using a discounted cash flow. But I think the discounted cash flow makes sense simply because of a very simple Buffett principle, which is that the value of a business is the total amount of cash that it produces for its owners. And the discounted cash flow is the most raw, simple way of coming up with an estimate for that. And not just because Buffett says it, it makes logical sense, right? Yeah. What you get back from an investment is what it's worth to you. And if you think about owning a business like you own the whole thing, then, which is another good principle to have, then what it returns to you is the total amount of cash flow that the business delivers over time. So that's kind of why I think Phil Town's methods are a really good introduction into the world of valuation. It kind of makes things a little bit easier to understand, I think. So I really do enjoy teaching Phil Town's methods, and I think they're valuable to learn. But discounted cash flow is a much more raw, I think, and accurate way of calculating value.
Sweet. Should we move on and do maybe one more?
Yeah. Let's do one more.
All right, sure. This is an easy one. Hi guys, great podcast as always. Thank you very much. I have a question about how to invest in foreign stock exchanges. If I'm located in the US as an example, how do I directly invest in Tokyo or England, etc.? Thank you.
Yeah, it's a good question. I think, it's just really going to depend on finding a broker that offers trading on those exchanges, right? There's always the option to do over-the-counter trading. So a lot of stocks that are listed on other exchanges, you'll be able to get them through this method called over-the-counter in the US, but it's usually more expensive. There's a lot less trading volume, so the stock price can be more difficult to get to a price that you want to buy. It can be difficult to find a buyer or a seller. So it's much more preferred, I think, in most cases to buy the stock directly on the exchange that it's listed, where there's the most significant volume for that stock. So you can do that just by, some brokers will offer, most brokers will offer the main foreign exchanges. If it's a really small exchange, it might be difficult to find. It might be more expensive. But in Australia, for example, all 4 major banks offer trading on, the US, London Stock Exchange, the Hong Kong and Shanghai. But not all of them are, a lot of them are quite expensive. So you kind of have to shop around a little bit and find one that's reasonable. But do you have any other thoughts on that?
No, that's all I was going to say. I was just going to say it just comes down to really your stockbroker and just finding a broker that allows you to invest on those. So it's just get an international share trading account.
Yeah,
that's all I was going to say.
Yeah.
I don't really have any insights apart from that.
No, and you just have to be careful. Remember that you're probably paying a fee for currency exchange and brokerage. So rather than just paying for brokerage, you're obviously converting into a different currency to buy it on that exchange. So there will be a spread there as well. And for, at least in Australia, I know that that's for a lot of brokers, that's where they get you. That's where they'll have quite a significant fee. So make sure you're checking on that. But yeah, I guess we can probably wrap it up there. We've been going for over an hour now. So thanks everyone for tuning in. If you have more questions for next week, then feel free to head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and leave your questions as a comment below. And we'll just add them all and try and get through as many as possible next week. But
absolutely.
Thanks to Sharesight for sponsoring this week. Sharesight.com/young investors. If you want to check out a free plan or sign up to a paid plan and get 4 months off a yearly subscription. Thanks, Brandon, for joining me as always.
All good, friend.
And we'll see you guys next week. See you later, guys.
See you guys.